Welcome, everybody. I have the privilege of introducing our first panel and hopefully asking some good questions, though I've encouraged each of them to get into heated debates for the audience and get very argumentative. We'll see if that plays out. But let me first start by just introducing everyone who you see up here, and I'll start to your right, my immediate left, with Dr. Jeff Shen, who is the Managing Director and Head of Asia and Emerging Market at BlackRock in their Scientific Equity Group. He's been at BlackRock for over 4 years, actually since 2004, I should say, and he started obviously at BGI there. Prior to joining BGI, he was Global Head of Macro Absolute Return at JP Morgan Fleming Asset Management, where he was responsible for asset allocation research and macro investment. Dr. Shen began his career in 1997, working in portfolio advisory, fund of hedge fund and risk management research functions at JP Morgan, both in New York and London. He's also an adjunct professor at NYU and teaches MBA classes on international investment. To his left, we have Jim McKee, Senior Vice President and Director of the Hedge Fund Research Group at Callan Associates, where he specializes in addressing issues related to asset allocation, manager structure, manager search, performs evaluations for Callan's institutional clients. He joined Callan in 1998, and he's also a shareholder of the firm.
89,
I'm sorry, little dyslexia there. Thanks. Give him credit. 1989, thank you, Jim. Prior to Callan, he worked at the Pacific Stock Exchange for many years, where he was on the PSE's options trading floor. He has a BA in Economics and Environmental Studies from Dartmouth, and he received an MBA in Finance from Golden Gate University, and his studies there focused on publicly traded securities and capital markets. We also are joined by Ed Peters, co-director of Global Macro at First Quadrant, where he's responsible for all aspects of that product's development, model building, risk management, risk allocation, portfolio optimization. Prior to working in Pasadena at First Quadrant, he spent 23 years at Panagora, where he served in various roles, including equity portfolio manager, director of tactical asset allocation, chief investment officer of macro investments, and chief investment officer. He also, prior to Panagora, worked at Interactive Data Corp and Mutual Life. You might recognize his name from several books that I know many of us in the room have read. He's author of 3 books, including Chaos and Order in the Capital Markets, Fractal Market Analysis, and Patterns in the Dark, and he holds an MBA from Rutgers University. To his left, we have Eric Alt, Managing Director and Co-Director of Research at Hall Capital Partners, where he is head of the Absolute Return Group, which covers credit, distress, and absolute return investments. He's also a member of the firm's Investment Review Committee. Prior to joining Hall Capital in 2006, he spent 4 years as Managing Director in Convertible Securities at Piper Jaffray here in San Fran. He also had several leadership roles at Robertson Stevens and Piper Jaffray as well. Prior to those, he was also a principal in a private investment firm, and he started his career at Arthur Andersen as a certified public accountant in Dallas. He graduated from the University of Austin with honors and holds an MBA from Wharton. And finally, last but not least, we have Allison Bennington, partner and general counsel at ValueAct Capital Partners, where she joined in 2004. Prior to that, she was general counsel of Atrax, which was a joint venture between Deutsche Bank, JP Morgan Chase, Citibank, and Reuters that was established to form a global exchange internet trading market. She was also prior a managing director of Robertson Stevens, where she ran the legal department, and previously was a partner in the London office of Brobeck Hale and Dorr International, where she specialized in cross-border mergers and acquisitions and corporate finance. She's currently a director of Cytel Incorporated and holds a BA from UC Berkeley and a JD from the University of California. Okay, so obviously a lot of smart people on the panel, and so let's start. Maybe Jeff, let's start with you. Several of the themes that both Jeff and the audience sort of alluded to coming into this was talking about what's really changed over the last 18 to 24 months, and even perhaps within the backdrop of last week. So let's start with sort of the broad question, Jeff, which is, what, if anything, has changed in your approach to the market or your firm's approach to the market over the last, say, 18 to 24 months?
Sure. I mean, I think I want to probably highlight 3 trends. I think first one is actually given what has happened in the market over the last 18 months. I think people certainly have actually been thinking about risk management in a long and hard way. And I remember back when I started with JP Morgan, I was part of the risk metrics group, and it was certainly, market risk, credit risk was certainly quite important at the time. And every time you go through one of these crises, always there's going to be a new type of risk that's coming up. And lately, it's certainly been, counterparty risk, and also thinking about liquidity risk over the past cycle. So I think how we think about risk management is actually increasingly becoming more important, and also become much more multifaceted. You got to think not only from market, credit, liquidity, operation, counterparty, the list just goes on. And also, I can guarantee you that if we have this conversation 5 to 10 years down the line, the definition of risk will actually evolve again. It will be something that we actually don't know, we haven't actually thought about. So I think how do we think about risk management is actually continue, and also will actually become a center point of how we manage money going forward. Second thing, I think, given sort of all of us probably spend some time looking at Goldman's testimony, on the Capitol Hill, I think increasingly, I think from an investor's perspective, from our client-based perspective, people are increasingly thinking about, are you a fiduciary? Are you thinking on behalf of my interest, or are you thinking on behalf of somebody else's or your own interest? So I think whether we are actually truly fiduciary or not, whether you are truly independent or not, becomes much more important. Last thing I want to talk about is, I think there was actually alluded to a little bit, is, we tend to put things in the boxes. We think about quant being different from fundamental. We think about passive being different from alpha. We think about beta and alpha, or whatever alphabetic you want to put on it. I think increasingly we're actually seeing that investors are not necessarily looking for beta or alpha or quant or fundamental. Investors are looking for total returns with minimum amount of risk. So I think how do you actually think about all of these different things that we actually put it into little buckets in a holistic fashion, putting together a solution for our clients, especially given what actually have been going on for the last 18 months. It's increasingly important, and I think it's a challenge to the industry, and it's certainly a very important challenge for all of us in this room to be able to come up with good answers for our clients that can help our clients navigate the uncertainty going forward.
Mm-hmm. Jim, what's changed?
Callan tends to focus on fund sponsors in the defined benefit space, as well as defined contribution space. Certainly within that is a lot of divergent interests, and I can certainly say in the last couple of years, there's been, within the firm and within the client base, a lot of introspection on the policy mix. And I think we'll talk about that later, but certainly defining your strategic vision at the client level is very important, and the ownership of that decision is important, as oftentimes, as we've seen over the decades, decisions are reversed at perhaps the most inappropriate time. But certainly as we look at this last couple of years, I think we've probably sharpened the pencil a lot more on matters like liquidity needs and rebalancing efforts. So those are the policy responses. I'll leave details to others.
Ed, care to comment?
Sure. One of the issues that have been facing us, which has come in high relief from the last few years, I'll go back for the last 3 or 4 years, is the fact that risk itself is not a static concept. One of the problems with quant analysis, I've been a quant for 32 years now, is that we tend to average things over long periods of time. And in averaging things over long periods of time, you tend to distort the actual dynamical nature of markets themselves. And the biggest thing we've seen in the last few years, even though it's happened over and over again through history, is that what happens when the markets go down is different than when the markets go up. And this is particularly true of diversification and risk analysis itself. So a lot of things which look like they diversify portfolios, for instance, on an asset allocation standpoint, give all their diversification on the way up. This is one of the issues with, say, high yield, emerging market debt, things of this order. Most of the diversifying effects are when markets are rising. And we do believe there is a distinction between beta and alpha in that beta exposure itself is tied to global economic growth. So the nice thing about beta exposure or general market exposure, whatever term you want to give it, is that it passively grows with the global economy. That's one of the reasons people continue to hold it, because it's basically cheap. And as long as you believe the economy is going to grow, it's still the biggest part of your total return over the long term. The problem is that we focused on alpha so much, which is very difficult. It's a zero-sum game. The beta, the way I described it, is not a zero-sum game. But we haven't really crafted portfolios in the correct manner because of the way we've looked at diversification. In particular, in looking at the downside, for instance, we find that many of the things that, or perhaps the only thing which really diversifies on the downside, are sovereign bonds. But the problem with sovereign bonds, of course, is that they have very low volatility compared to equities, which is what you're typically trying to hedge. So what we've done is basically ignore that and create portfolios which look like they're diversified because the capital is spread out. But when you actually decompose the volatility of the portfolio, the variance of the portfolio, you find that most of the risk is concentrated in equities, even if you have other pie slices which are in there, because there's also been a general misconception that the more pie slices you have, the more diversified you are, which may or may not be true. So what we need to do in constructing portfolios is to at least take into account the fact that low risk assets may be the diversifying assets. And in order to make them truly diversifying, you actually have to apply some level of leverage to them. And also come to the realization that moderate amounts of leverage on low risk assets is actually not risky. And the other thing is that in participating in economic growth and in having a growth portfolio, heavy dependence on equities is actually a problem when you're faced with global economic decline, because as I said, you participate in global economic growth, that's great, but you also participate in global economic decline, and you do need to hedge against that. So constructing a portfolios or funds which actually take all of these things into account from a risk management standpoint will actually maximize the Sharpe ratio over the long term, and that's the direction that we think funds are going to be going in.
Thanks. Eric?
Yeah, I'll come at the question maybe from a little bit different angle because our core business at Hall Capital Partners is building custom portfolios for clients which encompass everything from fixed income, equities, hedge funds, private equity, private real estate, and energy. We do everything through external managers. And so, you know, when I think about how we're thinking about risk, I would say at a base level, we're really not doing anything materially different, although we have, you know, really looked hard at how we can enhance what we're doing from a risk management standpoint, maybe with a, you know, additional emphasis on operations and some of the things that the other panelists have mentioned. I'll pick up on something that Ed said, which has been an area of focus for us recently, which is this idea of diversification. And I think in our view, you know, we've had maybe a little bit less of a quantitatively driven idea of diversification, and instead we've chosen to really focus on drivers of return at the investment level and to try and understand and make sure that the people we're invested with across broader portfolios are doing things that are different enough from one another that we feel like we're picking up some diversification benefit across our broader portfolios.